So at this stage, it's fairly rare to find the editors of two of the leading investment magazines in the same room at the same time. We are delighted to have Jonathan Eley, editor of Investors Chronicle, to share with us some of the things that Investors Chronicle has learned over its last 150 years. I suppose I ought to add that Jonathan hasn't actually been there all that time. So without further ado, Jonathan, thank you.
Thank you, Dave, and thank you for inviting me here today. It's a great honour. I'm very pleased to be here. Thank you all for making the time as well. Before I start, I thought I'd do my little commercial at the beginning. So here's a bit about the publication I edit. It started life in 1860 as the Money Market Review. The first issue of the Money Market Review featured a story about a debt crisis in southern Europe, various stories about runs on banks, and a plea for better auditing of public companies. So the life for the 19th century investor was not so different from life for the 21st century investor. And we have quite a large editorial team, not as large as it used to be or as large as I would like it to be, but that does enable us to cover more UK companies than almost any other publication. And that's really historically been the mainstay of our coverage. But we do other things as well. We're re-expanding, if you like, into things like property. We launched a new property section at the start of this year. And we have quite extensive coverage of funds. We do a bond tip every week. And we cover things like foreign exchange and commodities. In fact, that's tomorrow's magazine, and it's got 8 pages on how to invest in gold. We're owned by the Financial Times, so we have very strict rules on things like share ownership. We're not allowed to write about instruments that we have personal interests in. Nothing I talk about tonight will be things that I own or that I'm plugging. And we also have quite strict rules on editorial integrity and the amount of corporate hospitality and so on that we can accept. So pensions are a tax wrapper that's very sort of particular to your individual circumstances. So by definition, anything I say here tonight is going to be fairly generic. For each one of you, your personal circumstances will be different. It's very hard for me to provide tailored advice. So I'm going to stick to what I term the golden rules of investment. Many of these you may well be familiar with already. Many of them indeed are common sense when you think about them. But I think it's always good to be reminded of them anyway. First among those is to sort of know yourself and your needs. And that might sound very obvious. For instance, the obvious manifestation of that is, well, if you already have other pension provision from previous employments, from self-employment, if you already have substantial other assets or wealth at your disposal, your age, what sort of a lifestyle you would like in retirement, all those kind of things. But it's also about what sort of a person you are and how you want to spend your time. This is the sort of murky world of behavioural finance and how our personalities affect how we make investment decisions. Obviously, as Ross mentioned, diversification is crucial. This isn't some trading slush fund you're running, it's your pension. You absolutely need to guard against excessive risk-taking, but on the other hand, you need to secure adequate returns. Very important, I think, that you stay invested, and I'll have more on that later on. And also, as Francis alluded, the magic of compounded returns over very long 20, 30-year periods, they really do make a huge difference. And also, again, alluded to previously, but I'll touch on this again, is the need to keep costs down. So the 8 key questions, I suppose, for knowing yourself. How much have you got, as in how much pension provision do you have already? How much do you think you will need? How much can you afford to put into it now? How long have you got until you retire? And also these more sort of intangible factors. How busy are you? You've probably all got careers, you've probably all got mortgages, children, many of you may be self-employed. I think you have to be quite honest with yourself. How much time are you prepared to devote to this? If you're the sort of person who finds the idea of sort of pouring through company accounts as being tedium personified, then perhaps you would be better off investing in collective vehicles. Also, how disciplined are you? If you look at the sort of truly great investors, they all tend to have these systems that they stick to very rigorously and over long periods, even if that means that they're not actually doing anything for a while. Warren Buffett, I think, once said when he hadn't found anything to invest in for over a year, in one of his shareholder letters, he said, being so heavily in cash is a very painful condition, but it's not as painful as doing something stupid. And also, how risk tolerant are you? That will also probably depend largely on what your other financial arrangements are, and also how long you've got. The longer you have until you plan to retire, the more risks possibly you can afford to take. So to answer the how much do you need question, well, this is kind of the thought process that went on in my mind when I sat down and thought about this. So imagine you were retiring tomorrow. What sort of income do you wish to have? Once you've arrived at that, you need to find out what sort of a pension pot you would need to generate that income based on, say, current annuity rates. Then you would need to adjust for your age and the amount of time that would elapse until you retire and the effect of inflation in that time. And then you would need to apply a long-term growth rate. The one the FSA uses is, I think, about 7%, is the kind of annual investment growth that they assume. And then you have to make sure you're sitting down. And this next slide tries to illustrate why that is. This is me, by the way. I plan to retire, say, at 60. And if I were to retire tomorrow, I'd say, well, about £30,000 per annum would be adequate. I don't have an extravagant lifestyle. My expensive children will hopefully be off my hands by the time I retire. So the first thing is to apply the indexation to that. If I assume inflation of 2.5% a year, £30,000 actually becomes £64,500. So you might think inflation is low, but over long periods of time, it certainly has a big effect. The pot required to give me that income of £64,500 is well over £1 million, which is quite scary. That assumes annuity rates of 5%. Of course, not everybody has to buy an annuity with effect from next year, but I think many people still will, and it's as good a basis as any right now to do this sort of calculation. I should point out that annuity rates, of course, are historically at very low levels, but there again, so is inflation, or has been for the last 20 years or so. And that would require gross contributions, assuming 7% investment growth a year, of about £2,000 a month, which I can assure you is not going to happen in the immediate time unless I go and live in a cardboard box. So, maybe I should have started earlier. But I certainly should be contributing regularly. And maybe I need to rethink my retirement age, or the government will force me to perhaps, and my income needs in retirement. Retirement is often not as expensive as people perceive it to be. And perhaps I need to take more investment risks. Perhaps I need to have a more aggressive approach, take more risk to make higher returns. You might be wondering how I worked all this out. Well, I constructed a huge Excel spreadsheet and did searches on the internet for all the formula that I needed, and I was about halfway through this process, and Dave said, oh, there's a calculator on the Self-Trade site that does it all, and so it does, and it's actually a very good one because you can do it either way. You can start at the front of the process, or you can do what I've just done and start at the back with the target level and work back from that. The other beauty of this is that you don't have to enter your sort of email address or any details. You're not going to be bombarded with sales calls afterwards. At least I don't think so. So once you've sorted out how much money you're going to put into your SIPP, the next thing, and you've sorted out all the issues that Francis touched upon about administration and so on, and how much flexibility you want, well, then we're into the question of strategies. What are you actually going to do with the stuff that's in it? Well, let me start by telling that the way you allocate your assets over the long term will make far more difference to your returns than any choice of this instrument versus that instrument, this gilt versus that one, this share versus that one. So it's really crucial that we try and get this right. And by right, I mean as appropriate to your needs as you can. The way I think about this is these asset classes here constitute investment, to my mind. And the thing they all have in common is that they generate income. They have the capacity to generate income. Equities from dividends, bonds from coupons, property from rental yield, and cash from simple interest, although obviously not very much at the moment. The following asset classes are very exciting and very sexy and in the news at the moment. They don't generate an income. And to my mind, that doesn't really make them investments. It makes them speculation. all your return is coming from price movement. That means you have to time your entry and your exit very, very carefully in order to make a decent return. Now, I've put a sort of caveat in there about gold, and the next slide kind of shows that. I mean, we have a pretty unequivocal cover tomorrow. We think that the gold price will continue to rise for all sorts of reasons. But this chart shows the gold price since the Nixon shock, which was when the convertibility of gold to the US dollar ended in 1971, through to the present day. The red line is the dollar gold price, the blue line is the sterling one. And you can see that there were long periods of time when gold actually did not a great deal. And even when it did a great deal in dollars, it didn't necessarily do a great deal in sterling because it's priced in dollars and there's a foreign exchange rate risk there. So although I think gold is a good investment and there's all sorts of arguments about portfolio diversification, and although you can hold gold bullion in a SIPP, I would advise you to think carefully about whether you want to do so for 20 or 30 years, unless, of course, you think the world is about to end in a hyperinflationary catastrophe. So some possible allocation strategies. Well, a common adage in the markets is that your age in years should be your bond exposure in percent. So if you're 80, you should be 80% in fixed income, very safe, reliable generator of returns. If you're younger, say 40, then less than half of your exposure should be bonds. That's one way of doing it. Another way I quite like is the FTSE Atkins Index. It's the Association of Private Clients, Investment Managers and Stockbrokers. And these are three indices constructed to enable private investors to benchmark their returns. And unlike indices like the FTSE 100, which is composed of individual equities, the Atkins Index are composed of other indices, which makes them very easy to follow using collective investment vehicles. You can find details of those too on the self-trade site. The address is there. There are three. Growth, obviously, is quite an aggressive strategy, more equities in it. Income is more bond-heavy and property-heavy, and balanced is a mixture of the two. So you can see possibly that you would go for growth if you're just starting your contributions, and you would be looking at income and a more defensive bent if you were approaching the sort of drawdown stage of pension investing. So we hear a lot lately about maybe the sort of the end of the era of equities. It's been a terrible decade for equities. According to the Equity Gilt study, government bonds have outperformed them not only over 10 years but over 20, so on and so forth. Well, think again. I think, to quote Mark Twain, reports of equities' demise are somewhat exaggerated. This takes all the decades sequentially from 1899 to 2009, and you can see that equities came out top with regard to up decades versus down decades. And if that's not enough to convince you, we'll have a look at this one from the same body of data. The longer you hold equities, the more likely they become to outperform cash, certainly, and gilts as well over the long term. You can see there over 10 years, it's a 4-to-1 chance of outperformance. So those are pretty good odds in my book. Another golden rule is to stay invested. It's very tempting to look at the market chart of the FTSE 100 and say, oh, well, if only I'd got in there and then got out there, look at this whopping gain I would have made. Well, as Russ and Francis alluded, not all fund managers beat the markets. In fact, most of them don't. They have huge research departments at their disposal. It's their full-time job. If they can't do it, I'd invite you to consider whether you could. It's very hard timing the market consistently over long periods. Much better to get invested and stay that way. And that's what this study purports to show. It was done by Natixis, which is a French investment bank. They modelled an investment of $10,000 in the S&P 500 in 1980. And you can see that with all trading days, so they stayed invested for the whole of that time, it grew to nearly $90,000. Even if you just missed the best 5 trading days in that 30-year period, straight away your return drops substantially. If you miss the best 50 days, your return is 90% lower. I think you should just get in there and stay in there. And if you're worried about volatility in the market, well, there's things you can do about that. Pound cost averaging, where you make regular contributions, you end up buying more units when prices are low, is one example of that. With this eulogy to equities, you're probably thinking, well, if equities are so great, why do we need to bother with bonds and other asset classes at all? Well, the answer is that they lower the volatility in your portfolio. If you introduce a component of bonds, you don't actually dent the equity returns that much, but you do lower the volatility slightly. And of course, with a pension, what you're probably aiming for is reliable wealth generation year after year, not huge trading gains one year and then maybe big losses the next. And we've just talked about the magic of compounding. This is the reinvestment of income. This chart really says it all. It's the FTSE 100 since the the all share, not the 100, from the mid-1980s. The red line is the return with dividends. The blue line is the return without. They make an enormous difference to returns over the long period. If you plotted a similar chart for gilts, the difference would be even more pronounced because, of course, with bonds, the vast majority of your return comes from income, not from capital gains. In fact, I would go so far as to suggest that if you're not reinvesting income, why bother, really? I think it's so vital to the long-term performance of the fund. That quote, by the way, was from Albert Einstein, who knew a thing about powerful forces in the universe. People often say to me, well, I totally see the case for reinvestment. How do you actually go about doing it? Well, here is how. If you're investing in a fund, go for the accumulation units, which will automatically reinvest in more units rather than the income, which pays out as cash. If you're looking at exchange-traded funds, you'll often find references to distribution or capitalisation. That's the same thing. Basically, capitalisation is where the interest is, where the income is rolled up and used to buy more units. Distribution is where it's distributed to you as cash. You can reinvest, if you hold equities directly, you can reinvest the dividends. There are two ways to do that. One is to get a broker to do it for you, self-trade off for that service. I believe it's about £1.50 a time. If you hold shares through individual Crest membership, you can get, often if it's a large company, the company's registrar will do it for you and they will take care of all the paperwork, and the transaction charges are very, very low if you do it that way, but you do need a personal Crest account, which is that option. And one final word, if you're looking at shares or any other income-generating investment, don't just look at the headline yield figure. Look at the rate at which that yield is growing. So if you have two companies and one pays, they're both 100p a share, one pays a 5p dividend that's growing at 20 or 30% a year, and the other pays a 10p one that's only growing at 5%, you may think the 10% yield is a no-brainer. If you hold the stock for long enough, actually no. After a while, the yield growth will overtake the higher initial yield, but growing more slowly. So be careful to look for those shares that have been growing dividends consistently for many years. I think there's an investment trust that's just posted its 44th consecutive year of dividend increase. That's very, very powerful. Ross alluded to this, so did Francis. Costs, absolutely vital over the long term. They make a huge difference, even very minor percentage differences. But it's not just the sort of administration and management costs. Overtrading is the classic private investor mistake. We see that the next bandwagon go passing. We don't want to miss it. We end up spending far too much money on transaction charges, far too much churn in the portfolio. And a parallel sin is holding too many instruments. At the Investors Chronicle, we often analyse readers' portfolios. A gentleman sent in one earlier this year. He was in his 70s and he'd accumulated an investment portfolio of over £3 million. There were just 27 instruments in that portfolio. We got our behavioural finance expert to take a look at it, and in terms of diversification and risk exposure, he could not find a single fault in it. He would struggle to have improved it. Less than 30 instruments. You don't need to be holding hundreds of assets in order to achieve growth. It's often said, but I'll say it again, shop around. Hear a lot about people who just take the annuity that their pension provider offers. They don't take the open market option. It's the same as Francis said with SIPP provision. There's big variations. The cheapest may not necessarily be the best, or it may be depending on your circumstances. And also a word about passive versus active vehicles if you're investing in funds, straying into slightly dangerous territory here. But it is a fact that most fund managers do not beat the index, and they do charge more than passive vehicles. And again, this chart purports to show this, and there's plenty of academic evidence around this, but I actually went to the trouble of modelling it myself based on Self-Trade's actual dealing fee. I took the Atkins balanced portfolio, I took the 2 equity and the gilt elements of that. I assumed investment growth of 5.5%. I assumed charges of 1.5% for the actively managed fund and 0.5% for the passive one, which is around the average. And I added in the trading fee. I assumed you invest £3,600 a year for 20 years, and you can see the red line is the passive, the blue line is the active. It doesn't look like much of a gap at the top there, but it is about £14,000 over 20 years, and that's just from the 1% differential in charges. It does make a huge difference. So in summary, start by making a plan based on your individual financial circumstances. Start as early as possible, if necessary in childhood, as Francis alluded to. Regular contributions make it very affordable and much less painful than having to make very large annual contributions later in life. Do stay invested in the market. Don't try to time the market. Keep things as simple and cheap as you can. Reinvest the income, and possibly most of all, be realistic about the returns that you can get. This is not alchemy, it's pension management. I think I'm more or less on time, so I'll look forward to taking any questions later on, and thank you very much for listening.